During your reading this week, you learned about value-based management. This is a concept that is foundational for this course and will continue to refer to it over the next 8 weeks. Management decisions include 3 different types. Operating decisions. For example, what products are we going to produce? And then there's investing decisions, such as where should we build a plant? And then there's also financing decisions. For example, how will we fund our operations? All the decisions managers make can be fit into one of these 3 categories. And each decision that they make has a different impact on the business. Each decision will ultimately increase or decrease the value of that business. Operating decisions include things such as items that impact sales growth. For example, should we run a promotion that will increase our sales? It could impact operating profits, such as can we get a lower price for raw materials if we change suppliers? If we got a lower price, we would have more profit. And then there's income taxes. For example, what tax breaks can we get this year? Investing decisions impact working capital requirements as well as fixed asset capital that's needed to run the business. For example, what payment terms do we need to offer our customers? The payment terms are going to dictate how much accounts receivable we have, and therefore how much cash we've got tied up in accounts receivable at any point in time. A fixed asset question might be, how many machines do we need to buy to keep up with our demand? And then financing decisions will impact how much debt or how much equity does my business need. For example, should we borrow from a bank? If we do, what interest rate are they going to charge? Or should we sell stock? If we do, how much in dividends do we need to pay our shareholders? Operating and investing decisions should result in profits if the business is viable, and that's what we're going to assume in this class. Financing decisions come with a cost. When this profit from your operating decisions and investing decisions exceed the cost of the financing decisions, then shareholder value is created. And the time period over which this will occur is called the value growth duration. Now, shareholder value can be in the form of 2 things: dividends, which is cash the shareholders ultimately get, or capital growth, meaning the increase in the market value of their stock. Now, management should employ strategies that provide long-term value creation as well as short-term. So when you think about the value growth duration, it should be considered in consideration of both long-term and short-term decisions. Now, those strategies have a purpose. It's to pursue profit over the long term. Almost any business has that same strategy. And that is going to require setting and measuring performance targets, which is the basis of managerial accounting. Managerial accounting provides the information for management to set and measure performance targets to measure how successful management is at pursuing their strategies.